Thank you very much for providing me the opportunity to give an update of research on reverse mortgages being conducted at CPAR and the University of New South Wales. I'm going to give you an update on 3 projects. The first is looking at the optimal use of housing in retirement. The second is looking at the potential to use home equity for the purchase of long-term care insurance. And the third is looking at behavioural explanations for limited demand for reverse mortgages. So I'll look at the first project. So in this first study, what we were interested in is working out the lifetime benefit of different home equity release strategies. So we looked at downsizing, the reverse mortgage, the pension loan scheme, and home reversion. And what we did extensive economic modelling, looking at different economic scenarios, actuarial modelling, the age pension, superannuation, tax conditions, and we estimated for both singles and for couples the lifetime impact of taking these home equity products. So what I've shown, what I have here is the impact for a single female for 10 wealth deciles if she took an income stream of 1% of housing assets at retirement. And we can see here the huge benefit of taking a reverse mortgage or the pension loan scheme, which would give her the equivalent of up to $500,000, a lump sum equivalent, compared to not using housing assets at all. Now, if she took more housing assets or if she took a lump sum, the reverse mortgage would dominate the pension loan scheme. In our second study, we looked at the ability of people to use housing assets to buy long-term care insurance. And so we ran a stated choice experiment, an online survey, where we asked people to make choices of buying a long-term care insurance product. Now, this product is like a life care annuity, which would pay people income depending on how disabled they were. We put people into 3 conditions, and one condition, they could only use non-housing wealth to buy this product. A second condition, they could use non-housing wealth and their reverse mortgage. A third condition, they could use their non-housing wealth and home reversion. And we can see clearly here that giving people access to housing assets to buy long-term care insurance increased the purchase of that insurance. Not using the house at all, people only used around 5% of their household wealth to buy long-term care insurance. But giving people access to their house tripled that in the case of a reverse mortgage. We can see here that the people in our sample who were pre-retirees, people close to retirement who were homeowners, had a slight preference to taking a reverse mortgage over home reversion. So we can see here the huge benefit of people accessing their housing wealth to make a major expense in retirement in terms of funding long-term care. In our third study, we were interested in whether people would buy reverse mortgages and whether we could encourage them to buy more if we address some of the behavioural biases that people face. And those behavioural biases could be product complexity. People don't understand the product. Mental accounting. People don't include housing in the mental account to prepare for retirement. And narrow choice bracketing, where people don't think about the range of expenses that they need to undertake in retirement. So in this particular study, we administered an online survey to a sample of Australian pre-retiree homeowners, and we asked them whether they would like to buy a reverse mortgage and how much of their housing assets they would like to use. We put people in 5 different conditions to try and test different information presentations to address behavioural impediments. Overall, we found that 42% of our sample would purchase a reverse mortgage, taking an average of 13% of housing assets. And the people most likely to do this were the people with low housing wealth. For our different information treatments, we found that the mental accounting treatment worked best. So the mental accounting treatment was best at actually influencing people to take more of their housing assets to purchase a reverse mortgage. Broad choice bracketing worked as well, particularly for people who had concerns about the adequacy of their retirement savings. So overall, from this research that we're conducting at the University of New South Wales, we see that reverse mortgages and using other forms of home equity release have huge potential benefits for individuals. They can improve individual lifetime well-being. They can contribute to aged care funding. These products also have potential economy-wide benefits. They can improve the effectiveness of the retirement income system by encouraging people to use all of their household assets rather than just superannuation. And they can also support the sustainability of aged care financing by providing an asset such as housing for people to draw down and purchase long-term care insurance to supplement private provision. There's also some potential for reverse mortgages or home equity release products to provide an economic stimulus, but I think that'll be a long time coming because it'll take a while for these markets to build up. But in the event of a reverse mortgage market, I think our research also shows that it's necessary to address the behavioural barriers to the drawdown of these assets. There's still strong mental accounting where people don't think of using a house to support themselves in retirement. And there's still not very much awareness and low understanding of these products. So we have to work very hard to try and educate and inform the retirees in Australia. I think public policy is helping to some extent. The expansion and promotion of the pension loan scheme will help people understand about using home assets in retirement, and also the guidance that will be provided under the Retirement Income Covenant. But we still have a long way to go. So thank you very much for allowing me to provide an update, and I'll look forward to providing an update at next year's Three Pillars Forum.
In the first panel this morning, we considered the benefit to retirees if they can access all three pillars of their wealth in a holistic way. Now we turn our attention to the economy. Your second panel in the Household Capital Three Pillars Forum focuses on the economy and specifically the potential benefit to the Australian economy of releasing capital from the third pillar, home equity. The panel's topic is housing and funding retirement, the economic boost of $1 trillion of Australian retiree property. What impact could the $1 trillion invested in property by retirees have if it was freed from bricks and mortar? Could this save Australia from a potential recession? Naturally, we'll also look at some of the challenges and barriers to accessing home equity in Australia, as well as the experiences in both the UK and Canada, and what reflections they might provide for Australia. So to our panel. And with me in the studio are Emma Dawson, the CEO of Per Capita Australia, which aims to fight inequality and leads the way in establishing ageing as an opportunity rather than a burden. And on my left here, Professor Bob Officer, Chair of Acorn Capital and Emeritus Professor at the University of Melbourne, an eminent Australian economist and entrepreneur and long-time advisor on national economic policy. Joining us from Interstate are James Hickey, Actuary and Partner at Deloitte, and Tim Lawless, Research Director at CoreLogic, which is Australia's leading property market analysis firm. And with special thanks for making unusual times work, and we really do mean that, we welcome Andrew Kale, the CEO of the Retirement Division of Legal and General in the UK, which is a leading provider of lifetime mortgages in the UK home equity retirement funding market, and Professor Thomas Davidoff, University of British Columbia in Canada, a leading international academic in the study of the structure and function of reverse mortgages. So an enormous welcome to all of our panel today. Thank you very much for joining us. James, I'd like to start with you, if I can. You've worked in the space of Australian equity release for 18 years. $1 trillion tied up in retirees' property portfolios. What difference would it make if more of that was released into the market?
Thanks, Ali. Yeah, it's I have been involved in the sector for quite a while, so I have looked at what are some of the demand and supply aspects that do really come into play in this sector. But just to pick up on that point of $1 trillion, so I think that's a not unreasonable estimate of the amount of housing equity by retirees, retiree households. However, we do need to break that down, because whilst there may well be $1 trillion, the average loan to value ratio, which many lenders will actually release of that equity, probably is in the order of somewhere between 25 to 30%. So that does bring it down to a figure that's closer to $300 billion, still a very sizable addressable market for lenders.
Yes, I was going to say, I mean, T's, B's, I know that they do make a difference, but $300 billion is still an enormous amount of money. What sort of an economic boost can that be?
Well, if we look at it's probably good to put into context. We estimate that the current outstanding reverse mortgage market of commercial providers, and excluding the pension loan scheme, is only around $3.6 billion. So, we consider that at the moment that the market has really only penetrated around 1 to maybe even up to 1.5% of the potential addressable market that we just discussed. So certainly, even if it went up to the area where the UK and the US are, around 5% or more of the retirees using the product, then you could see a 3 to 5 fold increase in where the current market size is of $3.5 billion, well up to 10 to 15 billion if it got to the same level of uptake amongst retirees.
And I want to come back to the question of why where we are, if you like, in terms of numbers. But Bob, can I ask you first, does it make sense to access the equity in your home as a retiree?
Well, it certainly does for those who are capital rich and income poor. There is a lot of people of my age group, quite frankly, who are sitting on quite a lot of capital, and they're unable to or unsure of how they can access that capital for consumption. And so it would make a lot of sense to release some of that capital and use it for consumption purposes, for their own well-being and for the economy, because at the moment that isn't in demand, and of course it would go into demand once they release some of that capital into consumption.
And that's actually a really interesting point, that it would go into demand. I mean, a lot of people talk about the home as an unproductive asset, but this money would flow through.
There's no question it would flow through. It's the problem has been, I think, the reputation of reverse mortgages. It's been a hard thing to sell, but I think increasingly there'll have to be more pressure on it. I think by government as well, for the obvious reasons. Our debt is continuing to expand. The ability of the government to meet all the pension requirements is going to get less and less, and therefore they're going to look to methods by which they can relieve themselves of some of those pressures. And one of the better ways is to allow those who are capital rich and income poor to access easily some of that capital.
And we do, of course, have a government product, the pension loan scheme, which, as we heard in the earlier panel, has a pretty small, relatively small take-up, I guess. It's
Yeah, well, as I said, I think a lot of this is education. It's relatively new product, although, over 20 years ago I was associated with a listed company that had reverse mortgages. But it was hard to sell it, and because of the lack of information, I think, about them. Ostensibly the interest rates look higher, but that's because of the nature of the product. And I think with a government reverse mortgage there to sort of set a standard that people can get confidence in, I would hope to see an expansion in the private sector yeah.
Emma, let me ask you, because per capita, as we said, you work on inequality basically, and trying to fix inequalities in the system. So from that perspective, how do you see equity release?
I think equity release is really important for addressing some of the inequities in the system, in the retirement system more generally. So what we've seen, obviously, in particular over the last 20 to 30 years, is the value of housing and of land vastly outstrip increases in wages and income from labour, and a struggle to keep those welfare payments and pension payments and others in line with the cost of living. We do have, as Bob said, a cohort of retirees in Australia Australia that are sitting on very valuable property but are relying on the age pension for their income, and they're unwilling to draw down on, just as people are unwilling to draw down on their super capital, they're even more unwilling to draw it out of the family home. But for a lot of Australians, in fact the vast majority of working Australians, the family home is where their wealth is stored. And as we age, the capital gain that people have made on that property over the last 20 to 30 years is of no use to them if it's not improving their standard of living. So I think there's a fear amongst people of dipping into the family home. It's a security for them. There's also a desire to leave something to their children and not to shuffle off the mortal coil, leaving nothing behind. But given the significant capital gains in the housing market, I think we've got a cohort of retirees now who, with, as Bob said, a trusted government product to set a standard in the market and a number of other products coming online, could really improve their standard of living. And it's about enjoying those years of your retirement where you're still healthy and well enough to enjoy life, spending a little bit more money then so that you are reaping the benefits of having made that capital gain.
Is it also, though, from an equity point of view, of course, not everyone retires owning a home, so not everyone can access this product, but if you can get that money circulating in the economy, by default, it will help others who aren't in the same position.
That's right. So sitting on a lot of hoarded wealth, or wealth that's housing is a productive asset in that it provides shelter, but it's not moving through the economy. There's no velocity of that wealth moving through the economy. So if that money is released, we know that older people will tend to spend it in their local communities, so particularly in suburban and regional areas. If there's excess disposable income for older people, they'll spend it at a local cafe, local shops, taking the kids to the cinema. That then creates jobs in the economy, and it boosts. It does reduce kind of the inequality of labour and of wages as well.
And of course, if I could just intervene, it also gives them an opportunity to give their children some money while they're alive, and they can see the benefits of it rather than waiting till they pass on and not see the benefits of it. So, speaking personally, I think it's an important component of getting the capital out while you can.
Yeah, I mean,
and observe how it's being spent.
We have a generation, my generation, in middle age, who will, because of the very good news that we're living longer, healthier lives, won't inherit until we're quite old ourselves. So actually releasing some of that money now to say, well, let's help, if we are fortunate enough to be able to help the kids get into the market, let's do that, but let's also have a family holiday.
And this is actually a point, Tom, if I can bring you in here, because this is a point that you've made to me elsewhere, that we'll discuss just how popular reverse mortgages are in Canada in a minute, but I guess on the face of it, a lot of people look at it and think, gosh, the last thing I want mum and dad to do is to mortgage the house before they, die, because that means I get less. But that's not the way to look at it, is it?
No, in the stress case, the stress test might be the United States, where there's so many families. Think about the lowest quartile, even the lowest half of the income distribution. What family there doesn't have somebody paying 18% on a credit card, a child or a grandchild, doesn't have a roof that leaks and needs repair, doesn't have a kid in need of drug rehabilitation or bailed out from jail? When you've got situations like that, borrowing at 5%, you've got the opportunity to pay off debts at 18%, do very high return investments like fixing a roof. So yeah, I think rather than thinking of this as a greedy consumption by grandma, think about this as a way to let a whole family have access to relatively cheap debt.
And yet, Tom, I know that in Canada, it's not a particularly popular product.
No, US, Canada either. Canada, I think, was at about 0.5% pre-COVID. I think they've had a good year, 2020 into 2021, the two big banks, Home Equity Bank and Equitable Bank. So maybe we're pushing 1% of eligible seniors taking part.
So before I want to also look at what the UK experience is, but Tim, can I just ask you about property market in Australia and impact of releasing home equity? And I guess given where property prices have gone of late, it does change the equation, doesn't it?
Well, I think so. It makes a lot of sense to me, considering the Australian housing market. I mean, regardless of how much values have risen over the past 12 or 10 or 20 years, we still have a situation where about 55% of household wealth is held in the housing asset. and it would be, I'm sure, skewed towards the older age groups as well that are probably the prime beneficiaries of a reverse style mortgage. So to give you some context of the numbers, just the last 12 months, we've seen nationally housing values have risen by a little bit more than 18%. So this is the fastest annual rate of growth in housing values we've seen since 1989. And maybe it's just showing some early signs of slowing down now, but the annual growth rate, I think, will continue to rise for at least another couple of months. In terms of what does that mean for the overall asset class, it was only back in early April that we estimated the overall asset value of housing in Australia had broken the $8 trillion mark. And by the end of August, it had risen to 8.9 trillion. And almost without a doubt, by the end of September, we'll have an asset class that's worth about 9 trillion. So going back to some of James's comments a bit earlier on, I'm just wondering if that $1 trillion estimate of equity for retirees may even be a little bit conservative, considering the growth we've seen in housing assets over the past year or so. Over the past 10 years, clearly the rate of growth evens out a lot. We did move through a downturn for a long time between the middle of 2017 and the middle of 2019, which means the annual growth rate over the past 10 years is just a little bit less than 5%. But that's still well and truly higher than wages growth, which is averaged around 2 to 3%. And it just highlights that regardless of where you are in the country, generally most homeowners have been in the market for, say, 10 or had home ownership for 10 to 15 years, should be sitting on a pretty decent level of equity in their property.
But Tim, what impact, if more of this equity was released, what impact would it have on the market? Because in essence, it prolongs people downsizing, doesn't it?
Well, yeah, absolutely. And there's probably pros and cons of that discussion. But to Bob's point a bit earlier on, freeing up more equity, you're virtually injecting more cash into the economy. You're allowing a particular cohort to spend more. And to his point, I think that spending would generally tend to go into local communities, but it will also help some of the younger demographics getting their foot in the door. We know that housing affordability in Australia is becoming more and more challenging. To my point a bit earlier on, we're seeing wages rising in Australia at about 1.7% per annum. Housing's rising at nearly 19% per annum. So we're seeing housing prices rising more than 11 times faster than wages, which means more and more younger people simply can't get their foot in the door of the housing market by either raising a deposit or funding their transactional costs. So I think they're probably the two key aspects is if you are starting to see more capital coming into the economy, two really good examples of how it could be used would be helping younger people get into the marketplace because they're really struggling to do so, even with a lot of incentives from the government. And secondly, obviously, there's that consumption benefit as well with more spending. We know 60% of the Australian economy is consumption-based. It's people out there spending money on things. And freeing up $1 trillion or so or 300 billion, whatever it is, certainly would be a material improvement.
I think we can agree. If we don't know the actual number, we can certainly agree it's a big number. Andrew, can I ask you about the UK experience? How does the product work in the UK? Because I understand it's a pretty competitive market there.
Yeah, it is. So it's a product that's mostly offered by the major insurance companies. There is one major bank that offers the product, but generally it's a product that will be seen to be offered by the insurance company. And I think the product that there are some 400 derivatives on the market, so it's a competed market. But at its core, it's a mortgage, much like you'll see in the Australian market, where an individual will present a case for a mortgage with surplus equity in their home. A loan to value evaluation will be done on the valuation of the mortgage. Key to the UK market is the regulators require it to be a full advice model, so the individual has to take both financial and legal advice before they take out the mortgage. But after that, they receive their funds, and most of the time that sort of amount borrowed would roll up at an interest rate until one of two things happens: either the individual passes away, or they move into a care home. that would be the trigger for the mortgage to end, and then it would require the property particularly to be disposed and the balance repaid. There are a huge number of derivatives around that product. The most common one would be where you actually service the interest during the course of the mortgage, and therefore on the end of the mortgage, the debt effectively has been serviced. But that's a less popular product. The most common product is the capital is received, and then the interest rolls up to the end of the period, as I mentioned.
And Andrew, who accesses the product in the UK? Who's the typical customer?
So it's changed. I mean, Legal & General, my company, have been in this market since 2015. And just to give you a sense of scale of the UK, we do about between £4.5 billion a year of mortgages across the UK market. So in very crude terms, double that for Aussie dollars to give you a sense of scale. Legal & General, we would do about £1 billion a year of that. So we're about 25% of the market. And I would say if you go back to 2015 when we entered the market, the typical customer, of course there's no such thing, but the typical customer would be an individual who didn't have sufficient liquid pension savings and therefore needed to access additional capital to effectively supplement their traditional government pension and any private pension that they had. And it's fair to say that's still a large component of people that are accessing the product, because financially they need to supplement their other pensions. But increasingly what we've seen, certainly in the last year, and this is moving quite a pace now, are a group of customers, high net worth customers, who are accessing the product for some of the reasons we've talked about already. So that's actually intergenerational gifting, so it's gifting to children or grandchildren and providing wealth to the families. There's also a tax component in the UK. Inheritance tax is paid very significant amount on estates that are gifted outside of your spouse, even to your children, and therefore if you survive 7 years of a gift, that becomes tax free. So for individuals who are wanting to distribute their estate in a tax efficient manner, the equity release mortgage allows them to do so quite effectively, completely within the tax landscape. So that's also quite a significant growth in high net worth wealth customers that are accessing the product not on service grounds, not really financial grounds.
So Andrew, that really means there's been a shift. I'm sort of trying to summarise what you're saying, but there has been a shift from the product of last resort perception?
Yeah, I think it's an and. The last resort need is definitely still there. Pension pots in the UK are small. The typical pot size is around sort of 50, 60,000 pounds. So it's not going to fund a retirement that people want. So the last resort market is absolutely there and is growing. But this additional high net worth wealth component is something we're definitely seeing.
Tom, what about in Canada? Where's the perception of the product at the moment?
Yeah, I think, again, we don't have estate taxation here in Canada, so that clever way of getting away from that isn't a motive. The last I heard from the marketers, again, pre-COVID, this tended to be a last resort type product in Canada. It may be clawing its way up the income distribution. Just echoing something that was said earlier, with very low interest rates, the home values just get very large relative to a lifetime of earnings. And that has impacts early in life and late in life. Late in life, you just have almost everybody with a very large ratio of housing wealth relative to net worth. So it's just attractive to supplement your lifestyle with the home. But then when you look at the grandkids or children, coming up with a down payment for a home gets very expensive when rates are low and prices are rising. And so that transfer makes a ton of sense, and it's just inevitable that we're going to see some of that.
James, if I can bring this back to the Australian market, and I wonder, what do you see as some of the challenges in this sort of equity release, in people accessing the product here? And to what extent has it been seen in Australia as a product of last resort?
Yeah, we really need to look at the challenge across demand and supply. Speaking of the supply issue, that's probably the greatest challenge, and it is interesting in the UK market. It was mentioned that insurers are often the provider. Looking in Australia, no insurer has ever offered a reverse mortgage. There's a key difference there here in Australia is that we don't have a very big annuities market or a defined benefit pension market. Those markets do exist in the UK, which means there's probably a good hedging and funding reciprocation that goes on. If you're offering annuities, then often lending that out as a reverse mortgage can be a good way to term match the asset and the risk that you're taking on the annuity and defined benefit side. So in the absence of that in Australia, that's why insurers have not been that interested at all in the product. So then it really leaves it to the banks to offer the product. And to put it in the context, the forward mortgage market or the traditional mortgage market is close to $2 trillion of outstanding lending. Even if the reverse mortgage market was in the order of $30 billion, if it had a 10% penetration rate at the $340 billion market, that's still a relatively small sum for our major banks. So it's always been difficult for our major banks to want to offer the product in a sustained way and promote the awareness of the product and promote the education and support the consumer use cases of the product. So what that's led to is largely non-bank lenders or niche lenders being the ones who have really, I suppose, carried the heavy lifting on offering the product, both from a product design and a funding perspective, but also importantly on the marketing, the educational awareness, the financial literacy of the benefits that reverse mortgages can provide. So probably in Australia, it's been a story over 2 decades now of supply side issues. I think a lot of people recognise the demand side opportunity is largely there, but at the moment people really aren't being able to be informed about the product, how it exists alongside the age pension and the superannuation system, and therefore without that awareness, then it's not really being taken up by consumers.
James, is that an issue with advice? Because you're unlike financial advice for people who might look at various retirement products, this particular product in the Australian market has to go through its mortgage advice. It's a different licensing system.
It is a credit product, the reverse mortgage product per se, so therefore it does need to be issued by a licensed credit representative.
And is that an issue? Is that an issue when it comes to people being, if this being put on the table as an option, that financial planners per se don't tend to do it?
Well, probably then, Ali, to flip it around a bit, that means that largely to offer the product through your own credit license, you can either go yourself as a lender to the consumer, or you can use a mortgage broker. Generally, as we know, mortgage brokers often target more the first home buyer end or the investor or the refinancer end of the market. They're not often advising retirees on other credit matters. So it does take a particular mortgage broker to want to actually understand the product and to deal with the complexity involved in having such discussions with retirees, which then means when you think about the obvious distribution channel, which would well be financial planners, the challenge has always been to gain awareness of financial planners about the role of the product. Many planners have focused a lot of their careers on the pre-retirement phase for Australian consumers, given the significant superannuation system which we have. Increasingly, we're seeing more advice turn to retirement income. The government is bringing in a retirement income covenant for superannuation fund trustees, which will, I think, shift the game in terms of the need to come up with retirement income strategies for their members, and part of those strategies have to consider not just superannuation monies in retirement, but also all the other forms of wealth that people have in retirement.
And we'll look at that covenant in our final panel for the day. But Bob, you mentioned at the very outset some of the issues, the challenges to people taking up a product like this. Do you see it as a product supply issue? Do you see it more as an advice and awareness supply?
I see it more as the latter. As I said, over 20 years ago, I was associated with a listed company that tried it. I think the advertising budget required is significant. There's certainly education issues. Back to financial planners, not many of them understand it. They tend to be scared of it. So I personally think it's an education issue, but Of course, I'm an educator, I would say that.
What do you think? What do you think would be, Emma, would make a difference to releasing those dollars tied up? How do you sell it?
Yeah, I think it is a demand issue, as much as I think the market's there ready to provide this product, but there's a lack of demand, and for some of the reasons that James talked about with the banks there as well. But from our research, we've done a lot of research with older people and their feelings about their financial security as they age, both in relation to superannuation and the pension system, but also the housing market. The behavioural barriers are what's interesting to me, and there are three key areas that emerge as preventing people from taking on this product. The first is fear of what will happen to them if they need care in their older age, so people in their 70s being very cautious about how they draw down capital because of a fear that they will need it for aged care, and a lack of trust in the residential aged care system, and a lack of faith that the in-home care packages will be available when they're needed. So there are some policy fixes around aged care that would give people a greater sense of security. The second is the cost of accessing these products. Sometimes people think about, well, if I'm removing equity from my home, they tend to think in terms of big fees because of the experience with stamp duty and so on. And so that education part to say, well, it's effectively a reverse mortgage, you'll pay an interest rate, but you're not going to encounter those barriers that you do when you're trying to downsize, for example. And then I think the other issue is there's a lack of understanding in the broader policy community about why people stay in their own home. And there's a feeling that people are emotionally attached to the bricks and mortar, whereas often it's that they're attached to their community. And so if they felt that they had a secure product, that they could stay in that home, in that community, but not have to curtail their lifestyle in order to do so, or be forced into an inappropriate smaller property, then it could be quite attractive to people who've otherwise resisted releasing that money. So there are public policy issues, and I think the big one for me is a lack of faith in what happens to us as we need care. That the government could fix, that would then, I think, alleviate a lot of the fears that people have.
I guess that the whole point of today's discussions is about those three pillars. You can't look at any one in isolation from another. But the emotional side, I mean, Tim, I know that you're a man of numbers and analysis, but when it comes to property, people's sense of optimism is very tied up with it in Australia, isn't it? And I know it's the same in many countries, but, you know, the home being the castle is a big part of how we perceive property.
Yeah, absolutely. Consumer sentiment is a key factor in determining, or maybe not determining, but consumer sentiment and housing market conditions generally run in parallel. When people feel more confident about their own financial position, or about their ability to hold a job, or the domestic or even global economy, they're much more confident in making high commitment decisions. And we know that housing is very much one of the highest commitment decisions anybody will make. So it's probably not surprising to see there is such a close relationship or correlation between sentiment levels and housing market activity, and then of course on value growth as well. And that's been one of the really interesting things through this whole COVID period, is that we have seen, well, initially consumer sentiment tanked. It fell very sharply. It fell down to recession-y levels in the space of a month, whereas in the last recession we had in Australia, it took a couple of years to get down to recessionary levels. So we did see confidence impacts get impacted really, really sharply, but it was very short-lived. As soon as we started to come out of lockdowns and we saw a lot of the restrictions easing, as temporary as that's turned out to be for a lot of people, we saw sentiment absolutely boom on the back of an economic recovery and a lot of fiscal support and monetary policy support, and the housing market's gone along with it. So to your point, Ali, I think if we can get a product around freeing up home equity where people aren't sceptical about the conditions or the rules or the framework that exists within, that's probably one of the biggest obstacles to get something like this into the market. I think as a country, Australians do tend to be a fairly sceptical bunch, and having more, I suppose, proven successes and maybe mainstream operators becoming more involved in this sector is probably going to go a long way to getting more people confident enough to be involved in freeing up some of their equity and using it for much more productive purposes than just having it sunk there in their home.
And actually, James, this is something that Bob referred to, but the fact that we have a government product in this space, is that not of enormous assistance to the credibility of the product?
I think it should be, Ali. It should significantly legitimise the product in the eyes of many consumers to have the government actually offer a version of the product, albeit it's in a relatively limited capacity, but for many people may well be a suitable product. That very much should help around giving consumers confidence in the legitimacy of the product and the strategy of releasing equity from your home to support your retirement income.
Bob, how do you see advice for this product? Because when you look at something like accessing this particular pillar is right down to quite detailed advice, isn't it? We're not talking broad retirement strategy such as outlined under the Retirement Income Covenant, are we, at this point? This is detail.
It's detail. It's the sort of detail I'd expect a good financial plan to be across, because reverse mortgages, while they're not suitable for everyone, you would expect most financial planners to understand, and particularly if they're giving advice to older people, because it's been mentioned, they're likely to have more of their wealth tied up in the house than other groups. And it goes to, I think, removing some of the shibboleths that have been associated with reverse mortgages.
Which has been done, if you think about it. I mean,
well, it is, and it's slow to come. But if I think back, when I was teaching finance at university level, we always used mortgages and showed how they work. I can never recall anyone pointing out a reverse mortgage. They weren't, in those days, many of them around, but they were around. And again, it comes back to, I think, creating an awareness. And I think, as I said earlier, the government product there gives it a credibility.
Mind you,
to work
not many
off.
People know about the government product.
Indeed, and this is an issue. I think governments, I think, are increasingly becoming interested in the reverse mortgage because it'll relieve pressure on the pension. Amongst other things. And the other thing that hasn't really been mentioned, of course, it enables people to stay in their home longer, and that prevents them from going into the villages, the age schemes, which is another drain on government expenditures. So it's got that double benefit from government's point of view to encourage this. So I'd expect government to step up its advertising or acknowledging the importance of reverse mortgage.
Do you think, though, Bob, that there is an issue here, sort of an elephant in the room, and that is that just as the home is not part of the assets test for the pension, there is this unwillingness of government to go anywhere near the home, even if it's about accessing equity in it. It's just this, politically, it's unpalatable.
Yeah, I think that's certainly true at the moment, but the way we're going and the level of debt as it keeps growing, I don't think there'll be any option for governments. I can foresee newer taxes coming in. We've talked briefly, there's no inheritance tax in Australia yet.
Well, that'd be a brave government, wouldn't it?
It's certainly not in the next election cycle. I can assure people of that. But after that, there's going to be problems in funding this. The level of debt to GDP, while in Australia relative to the rest of the world, is not spectacularly high, and it's manageable at these low interest rates. But once interest rates start to rise, it'll become less manageable, and the governments will have to start looking to other ways of funding it. Taxes is one. It's unlikely we'll get the sort of growth required to alleviate some of this debt.
You've advised on economic policy for a long time. Do you think we will see within a decade, say, or at least a portion of the family home in the assets test?
I could certainly foresee that, and it won't be the whole lot. It'll be, I would imagine, talking in current context, perhaps the first 700,000 or 1 million is alleviated, and after that it'll be a gradual proportion, so that they've got to sell it, and of course there's equity issues involved here, and so that's why it'll be a partial thing. But I can't foresee governments being able to continue on the current trajectory without adopting something like this. But it'll take a while for a brave government to introduce it. Well, not unlike a goods and services tax. It took a while. There were some false starts. I think we'll finish up this way, because I can't see governments being able to meet their welfare obligations in any other way.
Emma, I would imagine you do agree with that, but also just on the saleability, is it that hard to sell? Because if you think about it, the removal of the family home, given that not everyone and increasingly people are not going to be able to own their own home, having it removed from the assets test for the pension in Australia causes huge inequities in the system.
Yeah.
And I mean, if you sell it on that front and you do it gradually and proportionally, is it that big a sell?
It shouldn't be. And I think one of the really disappointing things about the discussion around tax and particularly taxes on older people at the last election was that it was based in fear rather than fact. And I agree with Bob that not just on the basis of the amount of debt that the government holds, but the tax system as a whole will need significant reform in coming years. We rely far too much on taxing the income from labour and not nearly enough on taxing wealth. So I think one of the things that relates this back to the home mortgage product is to say to people, one way or the other, some equity is going to come out of your assets in the next 10 years in order to restore economic growth and to alleviate some of the inequality that exists, not just between generations but within them. You can either do that by releasing that money yourself. If you don't, then the government's going to take it in tax one way or the other. Now, I think there's a clever way of combining options, as they do in Canada or in the UK, the UK in particular, to say, well, you know, if you draw this down, then you'll be exempt from some taxes. But I do think that governments in the coming years will have to grapple with both the assets test on the family home for the pension. We know that the majority of people living in poverty in old age are non-homeowners. There are those asset-rich, income-poor people that own their own home and live on the pension, but they're a relatively small group, and there's an easy answer for them, which is to access equity. Including the family home in the assets test and looking at some form of estate tax and how that might work is going to be inevitable if we're going to get a lot of the money that's held in property assets moving through the economy again. And this is really necessary if we're not just talking about older people releasing their equity to help their own kids, but as a society releasing that equity and allowing it to filter through to all younger people. Otherwise we will be exacerbating generational inequality, where if your grandparents owned a home, you'll be able to, but if they didn't, you won't.
You won't. Yep. Andrew, in the UK, I suppose the issue, given what you were saying about how the product has shifted, particularly in the last year or so, how do you see the growth of the product and the marketing of the product, for want of a better word? You know, who it's going to best suit?
Yeah, I think we, for a number of years in the UK, we've been thinking we're on the verge of this product, and the phrase that gets used is mainstream, because even at £4 or £5 billion a year, it's still a very small fraction of the overall, you know, pensions market, mortgage market. So I think there's a sense of it, for all of the reasons we've talked about today, that the economic drivers, the social drivers, and as I say, even some of the fiscal drivers should mean this product should grow exponentially in terms of the market and its usage, and that is where people have been predicting for some time. But for all of the reasons, again, we've talked about on the panel, the emotional and psychological reasons why people don't want to use this product restrict that growth. There is definitely a structural issue in distribution, where only a certain category of advisors in the UK, a relatively small category, are qualified to advise on this product. Advising on the product has very significant current implications for their professional indemnity insurance policies, and therefore we have a bottleneck, if you like, in that the banks, who are the traditional providers in the UK of mortgage products, typically don't advise on this product, and therefore the natural mortgage market doesn't use it. And then the specialist independent financial advisory market, only a subset of that market currently advise on this, notwithstanding the commissions and brokerages on the product are higher than a standard mortgage. So I think we're in an interesting place where if you sit in the UK right now and watch daytime TV, you'll typically be flooded by equity release type products, because that's the way that providers are trying to get to the marketplace. Personal view is that's not the most effective way of doing it. This needs to be done with good, professional, holistic financial advice and really targeted at a proper customer conversation. But it's the market dynamics currently that I think are holding back what should be a naturally much bigger market.
And where does government policy sit? I mean, you talked there about the regulatory structures. Is there pressure for those structures to be in some way simplified to allow greater access to the property, to the product?
I think there is. We have a more general issue, I think, in the UK around what's known as the advice gap. We've created a regulatory structure which in many ways is very good and protects the customer interest, but it's often so much so that large parts of the financial services industry have moved away from financial advice, notably the banks, which is how many people access the marketplace. So I think we have a broader regulatory pressure here in the UK about how do we start to give customers good financial advice at a point in which they need it. And then specific to equity release, I think we need to engage much more proactively with the regulators about how they create a marketplace with the banks, with the independent financial advisors, and with insurance companies in a way that is focused on the customer. The government have been somewhat, I think, neutral on this. The regulators, I wouldn't say they advocate or are against this product. I think they clearly know this product can be targeted at vulnerable people, whether that's sort of typically the demographic of the customer buying the policy can be quite old. They can often be issues of family sort of coercion, etc. And therefore it's clearly a product that needs very careful advice, and therefore the regulator watches developments in the market very carefully, including the pricing, to making sure that we're treating customers fairly and we're providing a product that's value for money.
That issue of comprehensive, holistic and affordable advice is very much on the table in this country. Tom, what about in Canada? Tell us a bit about how you see the future of reverse mortgages.
Yeah, well, one issue I think that's come up is the role of government and consumer perception of risk. A safe product that could be very inexpensive would be something like the government's promoting in Australia, where you've got a very low loan-to-value ratio, still a lot of money, $250,000, say, for a 25% loan-to-value on $1 million. That's absolutely safe. And that can be lent at an interest rate close to the riskless rate, because the risk that the government's going to lose money on a 25% loan-to-value on a senior is very, very small. The experience in Canada, I've noticed, and also the US, is those cheap products with low loan-to-values. Because of this last resort type customer, there's been more demand for more cash up front with less attention paid to the interest rate. So having a no government guaranteed product at a high interest rate with high loan-to-value, that's a risky product. It has to have a high interest rate, and so it's only going to appeal as a last resort product. I think getting governments behind lower loan to value, pay interest through an annuitized component so that there's no risk of the borrower running out of money, and a perception that this is a safe product, it's a low cost product, the government's involved, I think that's a great way to grow markets.
And you don't think that you have that perception of safe in the Canadian market at the moment?
Well, again, it's a couple of private lenders. They're not well-known names. I don't know that they have reputational problems. I do know in the U.S. there's been big reputational problems, and those were exacerbated when lenders had to actually call in loans. You had borrowers who weren't paying their property taxes or insurance, and you had big-name banks saying, well, ladies and gentlemen of the court, please throw grandma out on the street because she hasn't made her payments. Lenders, of course, don't want to be in that position. And again, a lower cost, smaller loan to value product avoids that sort of headline risk.
Andrew, let me just go back to the UK for a minute. Do you ever see it becoming a mainstream product?
I do. I think the fact that now that it's highly competed has been actually good news for customers, because the prices from several years ago have come down dramatically. You're now looking at interest rates of around 2-3% in the current interest rate environment, so affordability is good. And I think there is just an inevitability. In the UK, we're moving from a situation of defined benefit pension schemes paid with a guaranteed sense of income to pension pots under defined contributions, which are generally much smaller. And we're seeing equity in houses rise considerably to the points you've already discussed. So as part of the asset base that an individual needs to draw down upon give them the retirement that they're aspiring to. I think it has to become mainstream, and that's before you get to the intergenerational gifting and the issues we talked about how we help children, grandchildren, etc., access property when the valuations have moved away from them. So I think there are a confluence of factors, which means it's hard to see that we don't see a significant shift in the marketplace in the coming years.
James, if I can bring it back to you, and before I ask you about whether it will ever become mainstream, we mentioned earlier putting housing in the assets test and whether we have an inheritance tax. I mean, how do you see that? Do you think any of that, well, I think we've probably decided it's not politically palatable in the short term, but do you think it's inevitable?
Well, in fact, the actuarial profession, of which I'm a member, released a green paper just this past month where one of the suggestions was, again, to consider the role of a cap on the value of the house that's included in the asset test. And it was, as discussed earlier, largely from an equity perspective, to ensure the system can be more equitable in the way in which certain assets are treated in the retirement income system. So I think there is a growing body of either academia or professionals that are actually raising this as a thing to look into. But as you said, Ali, clearly there's political considerations as to the timing and how such a thing would ever be implemented in Australia. But just in terms of another aspect I did want to raise is the most common form of equity release is downsizing. And that's individuals choosing to sell their property and move into a cheaper property. I think there's also issues there that the government has to look at. So particularly the frictional costs involved in downsizing can be a real issue, an impediment for people to actually sell their property and move to a potentially more affordable and more suitable property. Things such
because
as
the return's counted as an asset.
Two reasons. One is there's costs involved, such as stamp duty, but the second one is that the equity they free up. Now, the government did allow up to $300,000 of that downsized amount to be contributed to your superannuation, provided you're still within the $1.6 million cap. However, if it goes into superannuation, then it's classed as an asset against you for the pension purpose. So again, there's an attempt to give a demand side incentive, or if you like, a carrot incentive to downsize. But unfortunately, it will really only be a carrot for those people who are already self-funded retirees, because if you're already on a part or a full pension, then releasing that equity, even if you put it into super, will count against you for the age pension test.
So if I can just circle back to that question about whether it will ever become, equity release become a mainstream product, do you think that if we move to a world where the home does take on a different position in retirement funding, which may be a way down the track, but would that be a game changer for equity release as a product?
I think, well, what we're seeing, Ali, is there is a convergence of analysis being done, which is including equity release in its consideration. So the Retirement Income Review, which was released in December last year. Prior to that, we also had the Productivity Commission review. They were all mentioning a greater consideration for the role of the equity in the home in retirement considerations for Australians. So I think the really positive thing is it's now being brought into discussions. It's not just the age pension and superannuation. It's also now including other forms of wealth, including housing wealth, in considerations for people when they look at their retirement to an earlier point. I think that should give the incentive to financial planners to actually see it as an obligation upon themselves to understand the role of the family home and the repository of wealth that could present. Under the Retirement Income Covenant, it may well require superannuation trustees to have an understanding of the value of the home of the member and what role that could also play in a retirement income strategy. So there is a groundswell of momentum happening, and the encouraging thing is that equity release is being considered in a lot of those discussions. Hopefully that means that it'll become attractive for suppliers, and then obviously if they can help to educate and inform and get the financial literacy going, then that will tickle the demand that I think should be out there, and that will set us on a pathway to becoming a more meaningful product in retirement. Maybe not mainstream in the short to medium term, but certainly one which is growing from where it's been in recent times.
Tim, do you agree with that assessment?
Yeah, absolutely. And as James was talking, I was thinking about the distribution network in Australia. For traditional mortgages, about 60%, well, nearly 60% of mortgages now are being originated through third-party channels, being mortgage brokers. But I presume, I'm not sure that the rules around that particular distribution channel, but I presume a reverse equity style of mortgage may not fall within their remit or their qualifications or anything like that. So, I mean, tapping into a network like that for different types of loan products, including reverse equity, I think would be a real step forward in terms of awareness, ensuring that people are educated, the people that are actually selling these products or marketing these products are educated about the ins and outs as well, and also getting more people across the line or convinced to use them as well. And another point that James was making as well around the other component of equity release being, say, downsizes, I couldn't agree more. The whole stamp duty framework in Australia is just incredibly prohibitive and inefficient. A good on New South Wales for being brave enough, I suppose, to start walking down the path of trying to remove themselves from stamp duty. It's pretty brave politically, because you're moving from a tax that applies to around 4 to 5% of people who are actually transacting in the market each year to the 66 odd percent of people that own a property on a broad-based land tax. So I think that's probably the way of the future as well, is freeing up the taxation framework to an extent where it is more efficient and doesn't have these sort of financial obstacles in the way to allow people to downsize or move home without being financially penalised.
Emma, we have three pillars. If we put a fourth in of all the government assistance that you can access, maybe we need a fifth as well, which is tax system and other infrastructure around it.
Yeah, I think I absolutely am convinced that we do. And I think everything that both Tim and James said there is true. We see those taxation and cost barriers to people downsizing. We prefer the term right-sizing, actually, moving into a property that's appropriate for your age and your ability. But there's also a dearth of those properties available. And I think the tax question is really key here. We're coming from an era of relatively high growth, strong 29 years of economic growth before this global recession, and we're entering an era of lower growth, and that's been since the GFC. Most of Australia's tax policies over the last 20 years have been geared towards encouraging saving, and particularly encouraging saving amongst that generation that's now moving into retirement, the biggest generation, baby boomers, if you want to call them that. We will now need a broad cultural shift in our approach to the tax and transfer system that refits it for an era where we actually need more velocity of money moving through the economy. And so to discourage excessive spending, that actually means tackling a whole range of tax concessions on superannuation, on family trusts, on property ownership, neither side of which of politics seems to have much appetite for at the moment. But as Bob said, it's inevitable that at some point in the next decade, we need to rethink the way that our tax system is geared towards encouraging behaviour, because what we need is people to stop hoarding. Saving's good, hoarding is bad, and to move that money through the economy to the next generations.
Inevitable?
Yes, as I said, I mean, I don't see it as a party political issue, although one side of government may be more inclined to introduce these things early. It really comes back to the community as a whole. And we're getting a disparity in lifestyles and living between those who have assets and the way the GFC and the pandemic has been funded, and those that don't. And I think there's an inevitability for community harmony. You're going to have to rethink the tax system, and that's where I'm consistent with Emma's views on that.
And Emma made that point, that it will get to a situation where, whose parents own a home, you'll own a home. Parents didn't own a home, you won't own a home.
And that's never been the Australian way.
Look, we need to wrap this panel up, but I did want to just go back to the very first question that we were posing in this whole panel and get just a couple of brief words from each of you. If we did access more home equity to put back into the economy, whether that's Canadian economy or whether it's British economy, how big an impact, how big a difference could it actually make? If I start, Andrew, with you in the UK, is it a drop in the water, a pittance compared to the size of the UK economy, or can it make a really real difference?
Yeah, estimates are about 1.5 to 2 trillion of equity in the over 55s housing market. That's rising the whole time. So I think the numbers, even in a large economy, are meaningful. I also think, to the point though about the relationship between parents, grandparents and children, it could cycle, the societal impact and the benefit of sharing this wealth and creating liquidity out of an asset stock could have huge implications for communities, families, and society. So I think it could have a really big difference.
Tom?
Absolutely. I mean, just in terms of the struggle of the millennials and younger to get into home ownership, transfers from parents are already a very big deal. Transfers possibly from grandparents would help in that way. And, when you talk about taxation in housing, we do have in British Columbia already a sort of quasi-reverse mortgage in that you can defer your property taxes at low interest. As Bob has mentioned, property taxation, capital gains, regular property taxes are going to get more and more attractive as housing is a bigger and bigger share of national wealth. And of course, that only is going to be palatable if there's a way for seniors to put off the out-of-pocket payment, and reverse mortgage is one such way.
James, in the Australian context?
I think it can make a substantial difference to the quality of living for those people who need to use it. I think that is important to understand. Even $1,000 a month can make a big difference to people who otherwise have no other access to money over and above the age pension. But we do need to be careful in Australia because many people have, and it's growing, the amount of superannuation money which people will have. So to some degree, whether they draw down on their super or draw down on the equity in their property, that's a reallocation decision. So if they were to draw down equity in the property whilst they still have their super, in absence of drawing down superannuation, then it's just replacing one form of drawdown with another. But certainly for those people who are largely on the age pension and don't have enough super supply, which will still be the case for many years to come for retiring Australians, then clearly it can make a difference to those people who are largely reliant on the public system. The other area, though, I think that it can make a big difference is the broader discussion we had around facilitation of downsizing or right-sizing for people. Being able to have people be able to efficiently right-size their property, release equity in an efficient way and not have it disadvantaged in the tax system. It'll do two things. One is it'll improve the wealth for those retirees, but secondly, it brings supply of housing onto the market, and that trickles down through the property ownership ladder. I think releasing that supply or encouraging ways to, at the moment, avoid the disincentives to bring that supply to market will be quite important.
Tim, you'd agree with that?
Yeah, there's so many positives here, and I can't really think of any negatives. It's a positive for the economy because you're really encouraging or facilitating more consumption. It's a positive for the homeowners who hopefully free up some of their equity and use it for their own lifestyles or their livelihood, or to help the next generations get into the marketplace. And to James's point, there's also that really important consideration about a trickle-down effect. We know that housing supply in Australia is one of the factors that makes housing more expensive. And if we can free up or make a more efficient taxation system, as an aside, then we know that's going to add to housing supply and provide a much more efficient transport mechanism of home ownership from big homes for older people to big homes for younger families that probably need it more.
Bob, impact?
Well, I agree with all that's been said, and just highlight the latter point that Tim has made. I think there's an intergenerational benefit here in being able to use reverse mortgages and downsizing or right-sizing. The impact will be very high, I think, on particular individuals. I haven't done the numbers on a macroeconomic sense to know whether or not we're talking a proportion of GDP that's going to suddenly flow into it. I suspect it might be relatively small there, but the impact on individuals is no question. For those in that space, I think it's very important. And I just highlight the point about the inequity of, I think, using stamp duties and the like. They inhibit some of this intergenerational transfer, whereas a property tax that is based on facilities that are provided by governments, transport networks and the like, is much more equitable.
Emma, you've been nodding.
Look, I agree with almost everything everyone said. I'd just add that I think the benefit isn't necessarily going to be huge in terms of aggregate growth. I think there will be some impact on aggregate growth depending on how much is released. But it's about the distribution of that growth and the distribution of the wealth, both intergenerationally within families but also in the broader community. And I think that coming out of this recession, growth is going to be important important. But as Bob said, it's going to be very hard to grow as rapidly as we did, grow the economy as rapidly as we did after World War II, not only because of resource constraints but sustainability issues. And so I think even though both sides of politics are a little bit shy of the term, there is going to be more focus necessarily on the redistributive aspects of tax and transfer policies, and this is one that will have a real benefit there.
And bottom line, equity release is an option. And
That's
if you
right.
don't know about it, you can't even consider it. That's
right.
the first point. Thank you so much to all our panel, particularly thank you to Tom in Canada and to Andrew in the UK. Very weird times of the day for you, but thank you very much for joining us. And thank you also to James, thank you to Tim, and thank you to Emma, and thank you to Bob. You've been terrific, and we very much appreciate your insights. Thank you very much.